Well, good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN Sunday for Sunday, September 5th, 2021. We've got another great show this week. I'm going to be joined by members of the media, academia, and financial services as we analyze all the news this week in retirement markets, technology, personal finance, so much more. So sit back, relax, enjoy this episode of BRN Sunday. We're going to kick off the show recently, as we always have done. We're going to talk to the legal eagles. We'll figure out what's going on from the legislative, regulatory, and litigation front, and this time a lot more. Joining me now to discuss this is Kevin Walsh. He's a principal with Groom Law Group, an employee benefits law firm based in Washington, D.C. Kevin, thanks so much for joining us on this Labor Day weekend.
Well, Jeff, thanks for having me on, and listeners, thanks for celebrating Arissa's 47th birthday with me.
Happy birthday, Rissa. I think passed in 74, signed in 75. Is that right?
I think it was both passed and signed in 74. So it was
Okay.
Labor Day weekend. President Ford signed it. And here we are now, almost half a century later, still working through the same issues, and some of the issues evolve. I think today we're talking about an issue that no one would have imagined a planned fiduciary would be dealing with almost 50 years ago.
Yeah, and just to kind of tee it up, I mean, Kevin, when I think of you and David, I think about litigation, regulation, helping fiduciaries. Cybersecurity, though important, and I know we've talked about it on this program with you and David because you guys have been all around the country testifying and working through these issues, but this is not something that we would normally ascribe to benefits lawyers like yourself. So give us the latest. I know you and your colleague wrote something for plansponsor.com this week. What's going on with cybersecurity?
Yeah, so earlier this week, my colleague Ali Atami and I, we wrote an article for Plan Sponsor on cybersecurity. And one of the interesting things about cybersecurity is it cuts across many of the areas we talk about. It's not just litigation, it's also investigation, it's also regulation. And really, in the last few years, we've seen kind of a wave of participant 401k account balances get zeroed out by cyber criminals. And as a result of that, we've got the Labor Department, we've got private litigants, we've got a whole bunch of folks who are trying to figure out who's holding the bag. So, we've got Jeff Snyder, and he's got his 401k account, and he logs in one day, and he sees that instead of having, $100,000, he now has $0. He's upset. He's going to the Labor Department. He's also talking to private counsel. He's trying to figure out, is this my loss? Is it the employer's loss? Is it the service provider's loss? What's going on here? And as a result of this litigation, we've seen the Labor Department, they've started a number of investigations in this area. Some of this is fact gathering, where they want to understand what folks are doing today, so that they can, highlight what can be improved. Some of this is remediation, where if they go in and investigate a plan and they discover that the plan's procedures aren't, something that they view as sufficient, or that creates a high likelihood of risk, then they might sit over a fiduciary's shoulder for a while and really just sit there until they adopt procedures they want. And the Labor Department also acted another way, which was in April of this year. They issued a number of fact sheets and tip sheets that relate to questions a plan fiduciary should ask, what they think a plan fiduciary should be thinking about when considering their cyber procedures, and also tips for participants so that they can better protect their accounts.
Yeah.
They highlight one of the big risks, which is that participants have a tendency to think that if they haven't set up their online account, it makes their online account secure, and it's actually the opposite. Where if you haven't set up your online account, it creates a risk that somebody else will set it up, and then you haven't set up any of your mother's maiden name or whatever your security features are. So what we've been doing and what we're seeing is that plan fiduciaries are really now they're starting to take steps, if they haven't already, to put in place cybersecurity policies and procedures and practices to try to prevent losses to participants and plans.
Yeah, and Kevin, you made me think about something that I think ties in nicely with another topic that's important, which is you need to set up your account. If you don't set up your account, you're even more at risk. And when you set up an account, you have an email address and you put in information about where you're located. And that would actually help with the missing participant issue as well. So I think it kind of, one, it addresses the cybersecurity issue, which is important. But from a participant perspective, now you can be located if you have a balance of some type.
Yeah, I mean, it helps with that for sure, which is a very useful thing because we talk about missing participants, and again, that's another area where we saw the department essentially go through investigations to figure out what it wants to see folks do.
Mm-hmm.
But yeah, I think you're highlighting that missing participants and cybersecurity can be related.
Yeah.
Because if you're a missing participant and the department is encouraging plan fiduciaries to do everything they can to get payments to folks, it almost creates a perfect storm where there's got to be some higher level of risk when the plan is desperate to get the money out at the department's orders, and the participants essentially hiding and leaving no digital trail.
Yeah. Kevin, how prevalent, anecdotally, when you and David are in meetings and your colleagues at Groom are in meetings, where does this issue sit in terms of the hot topics that you're reviewing? I mean, let's think about all the things that you and I have talked about and David have talked about. We've got new regulation that could be coming down the pike, right? Entire retirement income. We've got ESG sustainability, which we've talked about for quite some time. And now we've got cybersecurity. And then we've got the regular fiduciary things that you're forced to deal with or you have to deal with under ERISA. So where does this cybersecurity issue fit in the priorities of things that you're talking about with clients?
So some of it comes down to committee structure. So if you've got a single committee that's addressing hot topics, we've had issues like COVID, ESG, the use of alts and 401k plans. They've all been kind of things that committees have focused on in the past year and a half. Mm-hmm. When we add into it, missing participants became a committee level issue. We've seen cybersecurity become a committee level issue. If you've got one committee that's doing both investments and administration, then these topics come up a little bit less frequently. If you've got a separate committee that's doing administration, then we're seeing cyber come up. It's starting to seem like some plans are taking an annual look at it, as it's a concern that continues to evolve, and we're still kind of in the infancy of one, the attacks, and two, figure out the best way to design defenses while preserving participant access to their account balances.
Yeah, are you seeing, Kevin, to that end, are you seeing, you mentioned clients, some clients, not all, taking an annual look at this. Are you seeing, how they do plan audits? You've done plan audits, right, for clients on data and other things to make sure that they have their documentation and contracts. And I think about all the things that I've done as an advisor with clients. Are you seeing now these audits annually where they're asking these some type of questions, but they can't be too transparent because you wouldn't want to give away the secrets to your protections. But are you seeing more and more plans go out there, and I don't know if it's an RFI or some type of formal process to ask questions about that? And lastly, or secondarily, who would do that? Is it something that a groom law professional would do? Would it be a plan advisor, or would it be another third party who would help with that?
Yeah. So Jeff, that's a great question, and
long-winded.
There's not a one-size-fits-all approach, but we have seen some larger plans in particular start to, really do an inventory of one, what are the cybersecurity weak points? Who are the service providers who are needed? How is this information? How are the accounts, secured and accessed? And as a part of that, we've helped a number of plan sponsors and plan fiduciaries in developing kind of a comprehensive list because, from my vantage point, when you have a list of who you're using and what they're doing, it puts you in a better position to evaluate whether they're adequate. Now, on the other side of this, and this is an issue that comes up in basically every one of these audits that we've done or every one of these, inventories that we've done. I like to call them inventories. Mm-hmm. But service providers have a pretty great response, which is, we'll give you a high-level idea of what we're doing.
Yep.
But we're not going to give you the nuts and bolts and all the details because, if we go out and publish, here's the treasure map of where our defenses are, and then the plan sponsor gets hacked or that treasure map somehow gets out, then essentially they don't want to provide a roadmap to getting around their their defenses. So it's important to understand what's being done at a high level, but it's
Hmm.
also important to recognize that you don't want people to be willingly turning over the keys to the castle.
Yeah, and I guess the last question here, Kevin. We've got fiduciary insurance, other types of insurances. Are you seeing more clients get these cybersecurity policies? And if so, and I know you're not buying them per se, but I would expect that with what's going on with Wawa and all these other breaches, that the cyber policy costs or premia are increasing.
Yeah, so cybersecurity policy is an area where we've seen a lot of evolution in the past, even 6 to 12 months. And the only thing I can say about them is that you need to take a close look at any cybersecurity policy you're buying, because they are not uniform at this point. The retention points, the carve outs, and the things that they need to see in place in order to trigger coverage um, really vary from carrier to carrier.
Yeah. Yeah, well, again, this is something that is getting more and more attention, not only in the retirement industry, but I guess both private sector, public sector, not for profit, all sectors of the economy. Kevin, we're going to leave it there. Thank you so much for joining us on the day before Labor Day. Give our best to David and enjoy the rest of your weekend, my friend.
Thanks, Jeff, and thanks, listeners. It's always good being on your show.
Thanks, Kevin. Take care. Welcome back. Now time to talk tech and consumer products. Joining us on the line, he's lead advisor and executive producer for Seven Investing, talking about Daniel Klein. Dan, great to have you back on the program. Happy Labor Day and great to talk to you this morning.
Good morning, Jeff. Thanks for having me. I don't know if you've noticed, but I have a new headset, so I think I should sound slightly better.
Well, I think you sound great, Dan. I think you're coming through. I thought you said you're going to have a new haircut. And Dan, just to remind you, this is a podcast, so we don't see each other. But I can envision if you do have your hair back in a ponytail, I'm sure it looks nice. Dan, let's talk a little bit about. I know you want to talk about Amazon, and it sounds like Amazon. They continue to reinvent themselves and go into new areas. Sounds like they're coming up with their own television sets in the U.S. here.
Yeah, so Amazon has for quite a while now sold TVs under other companies' brand names. So it might be like an LG TV, but it has like Alexa and Amazon Fire built in. That's one thing. Now Amazon is working on two angles. One is working with those third parties, but for Amazon branded TVs. So sort of like Amazon Basics, where there's just sort of a default brand on Amazon that you can trust, the price is going to be good, and it has everything you want. And then internally, Amazon is also working on designing its own TVs. Whether that actually happens remains to be seen. But I think this is really smart because look, I have an Amazon Fire. I have lots of Roku players. I am somewhat agnostic when it comes to to what my system is. I actually watch an awful lot of apps through the built-in one in my cable box, which is some sort of god-awful Android setup. But that being said, if I was buying a TV and I was on Amazon, which is usually where I buy a TV, I'd be very likely to buy an Amazon branded TV.
Yeah. I think it's interesting. Look, they continue to surprise me, Dan. And I like this. I mean, you have to be agile in this environment. You have to continue to reinvent yourself in order to be successful, both as a small business and as a large business. Do you see them doing this in other areas? Could we eventually see, Dan, I was going to say Samsung, Amazon car or an Amazon watch or an Amazon? We already see an Amazon tablet. So where else could they
So,
possibly go? Sorry.
so you have sort of seen an Amazon watch. I wore the Amazon Halo for a few months. It doesn't actually have a watch face. It's a fitness tracker. And for me, I liked it. It gave very good data. It had a very long battery charge.
Hmm.
I use it for sleep tracking and heart rate and things like that. The negative for me was it doesn't have a watch face. And I would look at it like 100 times a day to see what time it was. Well, it doesn't work. It's just like a wristband. But I don't think it's a big leap to go from fitness tracking into a watch. So that could happen. I don't think an Amazon car is going to happen, but Jeff, we actually got rumors this week of an Apple car. There was some pretty strong reporting that in 2024, Apple and Toyota would be jointly making a new car built around sort of revolutionary battery technology. Now, those words were just kind of thrown out there. There was not a lot of detail being put in. But if Apple, and this is a big could come up with something new in the battery space, that could be a game changer. That could get them in. And if they're working with Toyota, which has the manufacturing and the distribution, and I have to say, I'm very happy with my Prius. It wouldn't shock me if Apple sort of jumped the line and became a car player.
Okay. And uh, I guess it wouldn't surprise me either. And again, it seems, this is another innovative company. Dan, how did they get there? I mean, obviously they build computers, well, they used to build computers. They still build computers, but they also build, phones. And we're going to talk about the new Apple Watch rumors in a couple minutes. But how do you get from where they are
Yeah, so
today to doing that?
So Apple's had a team working on cars since 2014, and at various points they've focused those efforts on software for cars. So I'm sure you've used Apple CarPlay, even if you don't have it regularly.
Hmm.
And the times I've had a rental car that have Apple CarPlay, it works really well. It integrates with your iPhone. It's a really nice feature. And there have been times where they said we're not making a car, and times they've been pretty emphatic about it. It seems like they've figured out the right mix of where their software expertise and their hardware expertise can integrate with a car manufacturer. And I don't think it's that big a leap for Toyota, which obviously makes the most successful hybrid and has some pure electric vehicles, to jump into the car business with Apple. But I will say, for this to work, it has to be really, really different. And, we talked about fitness trackers and watches. I own, I don't know, a dozen of them. I bought a lot. Well, you don't buy a dozen cars. It is a really big purchase to get a car. So nobody's buying a car just because it has the Apple logo on it. It is going to have to be something special. But I do think if they come out with a cheaper battery, or a battery that has a 700 or 800 mile range, there is some room to disrupt this industry, even with a major disruptor like Tesla.
Dan, let's shift, and I want to talk about disruption. Let's talk about the new Apple Watch 7 rumors, and I think there's a lot of health benefits that they're talking about incorporating. Let's get your perspective on this.
Yeah, so I kind of want to say for all the rumor mongers out there, slow your roll. So
Slow your roll. I have not heard that in a while. Slow your
we
roll.
are getting, yeah, that's kind of a 70s term, I suppose. We are getting a lot of rumors about things like monitoring your blood pressure, or even your insulin levels for diabetics. And it is possible that Apple can deliver on that functionality, but the reality is, to do it from a medically valid point, you need to be cleared as a medical device through the FDA. And that's not a simple procedure. That is not likely something to happen in the next Apple Watch. So it is possible we have features that can, let's call it anecdotally, do these things and provide you some useful information, but it will not be medical grade information. So look, Apple Watches are pretty amazing. Like there have been numerous news stories about an Apple Watch that detects someone's heart rate spiking and tells them, hey, you need to go to the doctor. Like, your heart rate shouldn't be at 230 beats per minute, or whatever it is. And when I wore an Apple Watch, I found a lot of useful information. But it is a big leap to go from like tracking my fitness and being a helpful device to being a medically viable device where like a diabetic can use it to like track when they need insulin. So a lot of these stories, and I hate to bag on journalists, but are just written by journalists that don't have a medical background. And I'm lucky that we have Max Chasko and Dana Abramovitz on our team at Seven Investing, who both have advanced degrees in science and medical spaces. So they can sort of dig into the hype and say, oh, wait a minute, this might be cool. It might be useful for healthy people, but it is not necessarily going to be the tool you think it's going to be for people that have conditions that have to monitor this information.
Dan, I was telling you offline before we started this segment that I just finished rewatching the Inventor, which is kind of features the Theranos debacle and Elizabeth Holmes, and I'm reminded as we're talking about this, and as you just mentioned, your colleagues, their whole desire was to democratize, that word is so overused, but allow people access to get their biological life story from blood, right? And they were able to run all these blood droplets. And when they tested it out in Arizona, one, they weren't using their technology. That's a whole other issue. But people were kind of dumbfounded as to what to do with this data. And if you don't put things in context, right, if I get something that says that I have this, that I'm low in this particular mineral or thing, right? Then I don't understand the context, and I actually need a medical provider to do that. So how do you? What about the connectivity here? Are doctors using this watch data?
So they absolutely are, but again, it is too much data, and I think that is a problem. So I use my data with my trainer. So my trainer has a degree, a college degree, so he has some ability to interpret, and we look at things like where my resting heart rate has been for the week, not for the minute, not for the hour, but like when I was in Vegas, my resting heart rate was trending way higher. And not way higher, but say instead of like the mid 60s, like the mid 70s. And he sort of did the research and we tracked it down. It's well, just because it was so hot there, your body works a little bit harder. So, some of that data we check. I track my sleep, but there can be too much information. When I was wearing the Apple Watch and I could see my heart rate on a live basis, I would go, oh God, it's an 84, and I'm just sitting on the couch, and it's like you'd have to be like, well, did I have caffeine? Did I eat something spicy? Like, am I scared? Like what's going on? So yeah, you need context, you need medical providers, you need a doctor, and there is certain monitoring that can be done with medical services through these devices, and I think we're going to see more and more of that. But it's not going to be the next version. It's going to be a multi-year journey to likely the Apple Watch and likely other specific medical things to be able to say, okay, you are a patient with these heart risks. If these three things happen, go to the doctor. And in some cases, go to the emergency room or call an ambulance. We're going to get there, but we're not there yet. And the level of scrutiny and testing, I mean, right now, basically an Apple Watch is for entertainment only. And it's very useful. But like some things, like if I host a show, which is something you do, Jeff, I'm maybe a little more animated in my movements than you are. Sometimes after a show, an hour-long show, it'll be like, wow, you walked 3,500 steps, and I walked no steps. I sat in a chair, but I moved my arm, and my fitness tracker's on my arm. I'm doing it now for those of you who are listening along at home. And it's one of those things where they have to fix that for it to be medically valid. It is not great that my step count 3 days a week is off because I'm waving my arms and not walking. So this stuff has to get a lot better. And I think it will, and I think Apple will be the leader. And I expect the next Apple Watch to have some really cool experimental stuff, but realize what it is. Like I know like my Apple Watch now can do some sort of heart tests and blood oxygen, and I actually don't do them because I'm worried about accuracy, or I'm worried about if it's 2% in the where you don't want it to be, that all of a sudden I'm going to find myself waiting in line at the doctor when nothing was actually wrong. So I do think you need to be careful about context, and use the information you're comfortable with and talk about it with your healthcare providers and your fitness providers and all the other people in those universes.
Yeah, I agree with you, Dan. I think look. I had an Apple Watch. I've had several of them, but I always get, it being like in real time with my walking, or my heart rate. To your point, it just doesn't do anything for me. It just, I think it takes the focus away. It's like, Dan, I'll make the analogy, checking the stock market throughout the day, right? I mean, both of us talk about long-term investing. What good does it do you unless you're having a significant medical event, in which case you may not be looking down at your watch, you may be clutching your chest or holding your back, right? So,
Yeah, no, I feel like, so I'm wearing a Fitbit at the moment instead of an Apple Watch, and I feel like I've found a happy medium. The Fitbit now, I could click a few buttons and see my heart rate at any given moment, but it's not on the screen, so I don't see it regularly. What I see is kind of a daily rolling average. So I can get an idea of, oh, hey, geez, how come my heart rate has been like in the 70s this week when resting instead of in the 60s? And maybe I ate badly, maybe I didn't sleep well. I can make adjustments, and I can see the long-term exercise progress of, okay, when I first started this journey, my resting heart rate was 80. And if it's now like 67, that's a big improvement. So you get those milestones, but I think it's better as a person who's not trained to look at the longer term picture, and really see, okay, here's the aggregate data. Like I'm using a Fitbit because it has enough battery power that I can sleep with it, and it gives me a vision of how much I'm sleeping and what stages of sleep I'm in. And look, usually, do I know if I haven't slept well? Yeah, absolutely. I'm out on a cruise ship somewhere and I slept 3 hours because I went to bed at 4 and I got up at 7. Like, I'm pretty aware of that. But on a regular night where I go to bed at 11 o'clock and get up at 7, if I didn't sleep for 3 hours that night, well, that's important to know the next day and adjust my exercise and or figure out why I didn't sleep. So there's a lot of useful information here, but I do think you have to be very careful and worry a little bit about sort of overanalysis or just getting too much information. I actually felt like the Apple Watch gave me too much information and it was kind of scary.
Yeah, but at least you can answer your phones from your wrist. And messages. We're gonna leave it there, Dan. Always a pleasure chatting with you. I like the conceptual, theoretical, and the pragmatic aspects of our conversation. Wishing you and your family a great rest of the weekend, and enjoy your Labor Day. And we'll talk to you again next week.
I'll see you next week.
See you, buddy. Bye bye.
I wish that I knew what I know now. When I was young.
You need a financial plan that fits the way you want to live in retirement. A plan that can help grow and protect your money, now or in the future. With an annuity in your plan to help cover essential expenses, you'll have the freedom to live the retirement you want. This is what an annuity can do. Find the right financial professional to show you how. Learn more at protectedincome.org.
To make the break that we are on the brink of. My cup is on the table. My love is stealing.
Welcome back. And now time to talk markets. A lot going on, and who better to piece it all together than the lead anchor for the TD Ameritrade Network, Oliver Rennick. Oliver, great to talk to you. Thanks for making a few minutes for us.
Absolutely, Jeff. Thanks for having me.
Yeah, I feel like we always BRCC. That's a bum rush conference call you as you're walking off of the set. But let's talk about this jobs report and then piece together the last week plus of what's happened in the market.
Yeah, jobs on Friday, really interesting. Obviously not what the market was looking for, but when you get an extreme beat or miss, whenever you get an extreme deviation from the expectation, it at least helps provide some degree of clarity in market relationships and gives us an opportunity to see what's connected to what. And in this case, what we're getting is, once again, the NASDAQ trying to rally after a really bad number. And you're getting stocks kind of flat, bonds a little bit higher in yield, a jump in Bitcoin with risk assets, and a jump in gold. So one of the takeaways here is that this is a report that has the potential to potentially delay the timeline for the Fed in tapering their QE, their asset purchases, which has been a focal point for the market since June. But there are a few hiccups to even that takeaway because the wages component is very strong. That is an inflationary component, and the beat there that came in warmer than expected is a complication to the assumption that bad employment numbers are going to delay the Fed. But the market does seem to be kind of thinking about it in that way, that it's largely about what it would mean for Powell. He's told us that he's ready to start tapering this year, but he's also told us that that is contingent on the employment situation improving from here. So this is not really much improvement. It is certainly not their definition of substantial progress. So one could easily argue that today's miss, certainly if you get another one, then is, it'll delay the Fed's timeline for tapering. But what's very interesting here is more kind of what's going to happen next week, I think. I don't think that we've got a lot of great answers yet because we still actually have yields higher on the day, which suggests that the market is looking at tapering as an economic risk, and that's really important. That's been the explanation, the primary explanation that I have been offering for why yields have collapsed since April. There's two parts of it, and COVID is certainly part of it, that has also probably put some pressure on bond yields. But that's really only the last couple of months. Bond market yields have been dropping since April, and that has been a little bit of a mystery. for the market. But I think that we get some clarity after today's report, because if bond yields were actually going down in the summer because the market was anticipating a taper by the Fed, that would be logical if that taper is an economic risk, or if it is too quick for financial assets to handle, or something negative, basically. So then when you get yields actually up on this really bad number, it pretty much confirms that framework, that yields have been moving downwards on the expectation of the Fed tapering. So if that's been the case, then that opens up a really, really important conversation that is now, I think, one people are going to be having, because, again, yields up on a bad number suggests that the taper timeline got pushed out, which then would mean that yields have been going down, in part because the market was pricing in tapering. So it's all, a little bit convoluted, but it's important to try and kind of follow these steps and connect these dots.
Oliver, I'm not sure how the economists estimate jobs, and from what I've read, they were expecting somewhere between 300,000 and 750,000. So I don't know how you get that wide dispersion and how they calculate that.
Yeah.
But I can tell you that I've talked. It's a little off the. That's as wide as the I don't know, whatever.
Yeah.
But how do you reconcile? Or I've heard anecdotally that people go out to restaurants and there's no wait staff, or they have we're sorry. So how do you reconcile like small business job need? And I think there's a lot of, small businesses out there looking for people of all age ranges. I was going to say younger, but not necessarily younger, people of all age range. And they need servers, and they're willing to pay some amount of money. It may not be a fortune, but how does one reconcile, maybe not you, but how does one reconcile that need to this jobs report? Okay, well, are people getting some type of benefit? Are they getting jobless claims that's preventing them, or they're just like saying, hey, I don't want to do that work and I'm just going to sit at home or do something else?
A little bit of both. I mean, that is super important. I think it's definitely a little bit of both. So firstly, it has to be pointed out that the worst component of this jobs report is, again, the jobs that are affected by reduced travel due to COVID, and also some of those services components due to a dip in demand. However, generally speaking, the demand for workers is very robust. 10 million job openings as of last month, according to the JOLTS numbers. So there's definitely a mismatch here, where if those jobs aren't getting filled, there is, an issue that is not about demand. It is about supply. And we've known this is the case. We know that some people just retired early after COVID, said, okay, forget it. I'm done. I was close, and I'm just going to call it quits now and officially retire. But then we also know that there is an enormous amount of economic support for those unemployed that has been injected into the economy and is still lingering. Some of it is starting to wane. So one would expect those jobs to start getting filled. But at this moment, financial assets are at all-time highs. People have been making money. People are comfortable with the amount of wealth. They are buying things online without even buying them. There's buy now, pay later. People are really kind of extending themselves. And the point of all that is that consumers in America right now feel so comfortable and satisfied with their financial position that it certainly is dissuading them to some degree from seeking work that they believe justifies a higher pay rate. So the natural conclusion is that if we wanted to start hitting those big 500,000 a month or million jobs a month numbers, wages are going to have to go up. So that's a really important conclusion from this, is that it's probably actually an inflationary print, even though it missed expectations.
Yeah, Oliver, I get that. Were you a chess prodigy as a child?
No, I briefly dabbled, but no, now I play poker.
Yeah, okay. Well, something, just the way your mind works and how you're able to piece it together in such a understandable way really kind of speaks to that. I don't know, you'd be like a good strategy person, I think, on a team somewhere. But Oliver, we're going to leave it there. Really interesting, and I guess we're going to have to see how this all plays out. September supposedly is a month where things typically dip in the market. I'm hoping that's not the case this year. We could certainly ill afford more bad news. But we'll leave it there. Oliver, have a wonderful rest of your weekend, and we'll talk to you again very soon. And that wraps up this episode of BRN Sunday. Have a topic of interest, somebody you think we should talk to, drop us a line. And don't forget, for all the information in retirement markets, technology, personal finance, so much more, check out today's edition of our daily newsletter, The Morning Pulse. Well, we're not back again tomorrow because it's Labor Day. Hope you enjoy the extra day off in celebration of Labor Day. And we're back again on Tuesday for another episode of BRN AM. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.